Welcome all, and first of all, thanks for giving your valuable time to hear us out for our Talking Finance webinar. So this is a short webinar which will help you to safely sail through the month of September. So every month we do conduct this webinar at the beginning just to kind of guide as to what the important levels will be for the market, what events you should look forward to, how are the rollovers or positioning happening in the derivative segment, and lastly, how to strategize for the month of September. So to start with my webinar, first of all, if you look at the journey of the Nifty, in the last two series, if you look from the journey of the Nifty, from the swing highs of 25,650, we almost had a correction of around 1,000 odd points, more than 1,000 odd points. And it was more of an unprecedented fall, something which you can say caught the market participants by surprise, because there was a time where 6 to 7 weeks of one-way selling was pretty much apparent in the market. And there has been a time where lately there has been some intent of buying or some recovery or a base slowly setting up at the levels of 25,300 to 350 zone. Now, the volatility index, which basically tells us how the options premiums are priced for the beginning of the series, it is around 9 to 10%, which is almost at the lower end, or you can see the premiums are cheap. They're trading at their lower end. And the rollovers, if you were to see for the month of September, the rollovers for September has been majorly on the short side. In fact, for the month of September, the rollovers have been more than the 3-month averages. On average, 76% is the rolls which we see for Nifty. This time around, it is 83%. So that rollover itself does say that there is some direction which slowly is building up in the markets, for which the positioning has been pretty higher than what the averages are. So this is the backdrop with which we start our webinar. Short positioning, heavy in the Nifty, cheap option premiums, a scenario where majority of the parameters on technical price front signal that Nifty is oversold, and somewhere there is a signal that a short-term bottom around 25,300 may be in the making. Now, what has been the factors for September which one should look forward to? So as I mentioned, we still maintain that there is going to be demand on dips. Now, this demand area, if I were to dissect it and try to figure out which exactly is a good technical support, what the evidence gives me is that if you look at the charts which I have posted on the lower end of this swing on the screen, 25,250, 24,250, 24,300 has been a consensus support which has been developing on the price charts. Now, there has been multiple instances where the levels of roughly 24,300 has been successfully defended by the markets in all its prior attempts, which we have noted in the last 3 to 4 months. So there is a very strong support base which is intact. We have seen a recovery intent in the last 4 or 5 trading sessions from the levels of 24,300. And the way the initial price reading is, we are all set to conquer once again the levels of 25,000. Now, there is a seasonality factor. If you look at the month of September, it is primarily known for being a positive month. तो अगर आप लास्ट डेटा पुल आउट करें फॉर 3-4 years का, तो एक क्लैरिटी मिलती है कि आउट ऑफ लास्ट 4-5 years 4 बार सितंबर महीने में बाजार ने क्लोजिंग बेसिस पे एक पॉजिटिव इंटेंट दिया है, बाजार में एक पॉजिटिव क्लोजिंग दिया है. So that's one thing which you should always keep in your mind. Now, secondly, if you look at September is a month where there are strong or wild price swings on either ways between the highs and the lows in the market. So this also should be another factor which you need to consider, because September traditionally is a volatile month. Now, this is how the Nifty is positioned. Bank Nifty is normally seen as a leader for the index. Now, जब भी कोई बड़ी तेजी की बात करते हैं हम तो बैंक निफ्टी हमेशा एक लीड लेता है. So this time around the situation is a bit different because bank nifty is still not taking the leadership. So that is slight question mark because we are looking for signals which are followed traditionally, and ideally bank nifty taking the lead would have augured well for the market. So right now bank nifty is trying to defend, or you can say strongly defend, the levels of 53,500, which is a major support zone. And in case bank nifty does take the lead, we get a second level of confirmation that all the things are falling in place, and then we look forward for a good decent rally from the current market prices. How the derivatives data is positioned for the Nifty index, that would show you how the put writers and call writers are positioned. Highest open interest in the monthly 30th September expiry for Nifty at 24,000 puts makes one believe that that is the support or the maximum downside which market participants look forward to, and that is the reason the put writing base or the support base is developing at 24,000. Contrarily, 25,000 is the resistance zone where there has been a lot of call writing resistance. So with this backdrop in mind, we move to the next slide where we are talking about how the rollovers have moved for majority of the stocks. Now, if you look at the last few days, GST is what has been ruling the market. That is the news in the foray. Everyone is talking about which sectors are going to benefit, how the consumers are going to benefit out of all this. And if you really look at the market moves, two sectors clearly stand out in this entire way the things are unfolding. One is auto. You can even say the consumers durable or FMCG space, but after the move somewhere in the last couple of days, they have cooled off. So positive roles based completely on the data. We feel that auto, the metals, and the new age companies. So when I mean new age companies, they would be stocks like a Nykaa, an Avenue Supermart. These are the couple of stocks which have exposure to the futures and option segment. So these stocks have seen a positive rollover intent. It means long positions from the month of August have been taken over to the month of September. So these sectors have a positive long presence, and that is the reason why we feel that if you combine some technical indicators with them, they will see positive good returns or healthy returns posted for the month of September. So these are the sectors you can look forward to. Weak rolls or sectors where short positions from August have been taken over to the month of September primarily are IT, financial services space, and banking. Now, without talking about what the FIIs are doing in this entire market doesn't make really sense. So, because FIIs are the backbone, they decide the short-term flow of the market. So on the left-hand side, you have the cash numbers, right-hand side, you have the F&O numbers. And clearly, if you look at the price trend, August has been a month, July has been a month where there has been intense selling in the cash segment. So on an average, if you look at the last 4 months from March to June in cash, on an average, you can say 3,000 to 5,000 was the buying number in cash month on month, buying in crores. But last couple of months have seen huge outflows of cash figures from the FIIs, and that's really a question mark or a word of caution about traders, for the investors who are looking on making serious commitments from a longer term perspective. We need improvement in these numbers. We need those green pop-ups coming where month on month the data is positive. Unfortunately, the last couple of months have seen selling over average numbers. 46,000 on an average is 46,000 crores is the selling figure which you see in the cash. Contrarily, if you look at the F&O markets are continuously noting selling from the FII side. So from May, June, July, August, if you look at all the 4 months, on an average, you can easily say that 15 to 20,000 crores is what the average selling numbers are from the FII. So one thing is clear that there is pressure on the market. Yes, the bounce back intent is there. Oversold parameters have been respected, but really the bounce back is not materializing because the FIIs are not going full out. They are not pouring in the money as it was before. There is a hesitation and a lot of geopolitical pressure or the situations which have recently arisen because of the US tariffs is playing hard on the market. And primarily that is the reason why you have such huge FII outflow from the Indian market. So for an investor, it's important that these numbers change, which would mean that the market would show signs of stability. But as it currently reads, most of the numbers which at least I'm seeing for month-on-month data are running negative. So that would be a word of caution. So this number which I'm talking about, how FIs are positioned for the month of July, was 38% when they began the month of July. June was 20%, August was 10%, and September is 8%. When I say 8%, it means the long-short ratio of the FIs only in index futures segment. When I mean index futures, it is a combination of Nifty, Bank Nifty, Fin Nifty, and Midcap Nifty, the four primary products traded on the NSE. 8% longs, 92% shorts. That is a staggering number. That means just the huge degree of shorts which are prevalent from the FIIs in the future segment. So really the quantum of shorts in index are pretty heavy. It is a market which is a one-way market in terms of the negative positioning, especially from the foreign investors, and that throws caution because FIIs started the prior month with a long-short ratio of around 9 to 10. This month too, they start the month with a negative position. So there is not much change. So you may say that this is contrarian indicator. It is showing at its lowest band of 8 to 10%. How far can it go from here? But you need the numbers to improve before you take decisions. You cannot preempt, because in August, if you would have preempted, really this data wouldn't have helped. September as well. Let the numbers improve. Let this data from 8%, let it at least go up to 15%. Let that short covering, unwinding happen. That would throw us signals of buying. Till then, we would suggest to play it in part and parcels, play it day by day, and do not go for aggressive buying. Let there be more stability confirmations based on data. That's what the derivatives piece has to suggest. Key levels which we mentioned, 24,250, 24,300. The most important support. If by chance these supports were to break, it would potentially open up a head and shoulder bearish scenario for Nifty. We are right now not talking about that because our view stands positive. In case you need to have your lines drawn. So 24,250, 24,300 is the support. In case those levels breach, that would be a serious breach of support, and in that case we are talking about reversals in the market. Till then, we maintain a positive view on the market with upside potential right up till 25,200. That's the first stopover target for the month of September, with the best case scenario going as high as 25,500. So although the short-term view right now may be choppy, because if you look at the key events, we have just managed to digest the GST impact news, but still the street verdict is divided. There is a mixed consensus. Even the prices are not giving us a clear-cut direction as to which way things would unfold. And this choppy phase just means that 24,500, 24,800 is the zone which the market is dealing with. We will be buyers. We are not kind of shying away from changing our view because of the intraday choppiness. We are holding the view that 25,300 is the key support zone. Till it holds, we are maintaining a buy on dips or a buy on current levels with possible targets of 25,200 to 25,500. FII flows is what you have to monitor very carefully. The long-short ratio, which I just explained a few minutes back, that holds the key. Any unwinding in that data, if it moves from 8 to 15%, that's a positive takeaway. That means unwinding has kicked in. Global news and tariff updates will be what will be keenly watched, because India is already now 50% is what the tariff structure is. Now with dialogues, if anything positive were to develop, if this tariff structure has some room for getting soft, that would be a positive take for the market. The Fed policy on 16th and 17th of September, where there is a high chance of rates getting cut, is what can be the next level of trigger the market looks forward to. So this is the broader view for the market. There is a lot of short positioning still in the market. Broadly, if I were to tell you which levels those shorts are, 24,700 to 24,900. This is the zone where majority chunk of shorts are positioned. So for any short covering, 25,000 has to surpass. In case it does, that will be the momentum trigger for the market. Right now, it is a market where short positioning is active, but technical parameters are oversold. We are near key support zones, and we have to take a gut feeling call at this time. Looking at the broader technical parameters, the risk reward payoff, it does make sense to take a contrary view, a buy recommendation from the support, and if it works well, short covering unwinding should trigger, and the targets which we mentioned should be in the making. So just to play this entire view, we as always give you a strategy for the month of September based on the options data. So the strategy I'm presenting today is called a short strangle with buying of deep out of the money calls and puts. And if I were to name this strategy, you can call this an iron condor strategy. So please don't look at the risk reward payoff here because it will be a bit skewed. But the whole intent is that we are selling a put of 24,300 strike. That's the level of support which I mentioned. That's one lot. And we are selling a 25,400 call. So by selling 24,300 put and 25,400 call, we devise a short strangle set strategy, and we are collecting premiums of around 150 odd points by selling calls and puts. We are defining a range of 24,300 on the lower end and 25,400 on the upper end. Our expectation is that September the prices should stay within this range, not move out within this range. Time value premium depreciation benefit is what we are trying to get by devising this strategy. But in case there is some absurd movement which goes beyond the extreme ends of this band, then we are buying deep out of the money put of 24,000 strike at 45 and deep out of the money call of 25,600 to keep or mitigate our risks or keep our risks in control. So in case you have to work with a target and stop loss, the max profit potential in this strategy is 5,000. The probability of you ending up in profits, I think, is around 70% here. That's the estimation right now I have. And in case you want to keep a monetary stop loss on this strategy, please keep roughly around 3,500 as the monetary stop loss on this strategy. So this is the best case scenario or the best strategy which I feel works in this choppy market to deal with use of options. And I will conclude my webinar piece here and request all the participants to be free to ask questions on our webinar on the market path. And with that, I conclude my webinar. Thanks all for your time and participation.
Question 1. Up to when should the short straddle and strangle positions be held before expiry?
I follow a thumb rule when you're selling options, right? Ideally, selling options position, whether it is a short straddle. Short straddle is when you sell calls and puts of the same strike. Short strangle is when you sell calls and puts of different strikes. The whole idea when you devise such strategies is that you are playing for time value depreciation, and time is the essence here. Now, whenever the option premiums which you have sold, when they depreciate by over 80%, right? So for example, you sold a premium at 10 rupees, it has depreciated to 2 rupees. It means you are gaining 80% of the premiums. That is the time you should book your profits and not leave it for expiry. What most participants or most traders rather get caught on the market is they get the initial trade right, because the probability of such strategies working in your favor is almost 7:10. 7 target, 7 strike hits to 3 losses. And it's about managing these 3 loss conditions is all about the journey of a short strangle trader. So the problem which I encounter in majority of the traders is when you are in the money, it's in your favor, 80% is depreciated, and there is no chance which looks that you will end up in loss. You just give up your trade and you don't want to square up for that extra 2 rupees, and that's where it creates a problem sometimes when the market reverses hard. Even that small profits which you tried to pocket in, that 1 or 2 rupees, just bursts all the way to 100 odd levels, and that just spoils the entire strategy or gains which you have been slowly building up for months. So the thumb rule is when option premiums depreciate over 80%, please book out your profits and build a new strategy.
What is required for short covering if in any stock there is continuous short build-up? Can we expect short covering?
Yeah, so simple case is Nifty you can look at. There is a lot of short build-up as we discussed in our webinar. A lot of such stocks to make you may encounter where there is a presence of shorts in the system. Now, really, when short covering will trigger, see there are two things which you should understand. One is your gut feeling. Now, gut feeling completely comes with experience, and based on certain technical parameters, there are some lead indicators like an RSI divergence, which possibly gives you indications as to whether there has to be a change in the momentum or the reversal points in the market. But this is all based on gut feeling. That is one way where you take the position in advance, estimating that there will be a reversal. So we are calling short covering before the activity happens, before the data number shows up. So that means you are taking additional risks in the market when you take such a view, and you need to have your stop losses or your risk mitigation strategies in place before you do this. The other way is when let things happen and then you decide how you're going to go ahead. For that, the derivative piece of data comes into play. For derivatives, for short unwinding, you should get that minus or that short covering unwinding figure in futures. Call writers shedding their writing bets in options, where you see the OTM calls noting unwinding of option writing bets. So these are all indications. These come late. These come when prices have already bounced back. But then it comes with a confirmation that the short covering is in process and has started off. So what I would suggest is it depends on how well risk averse you are, how you mitigate your losses, and have some levels in place. For example, like in Nifty right now, the shorts are majorly seen in levels of 24,700 to 24,900 zone. So let that data points show up. Let markets sustain about 24,900. You need the market first to react, then you reacting before the markets. There's a lot of difference in this. So I always go with the policy that let the markets react. You may be a little bit late to the party, but it is always better to be safe than be sorry. And I always live with this principle. So that's how I approach the short covering markets for indices, or maybe it's for stocks as well.
Why do I observe options premiums increasing at the same time for both calls and puts?
Yeah, there are some situations, especially you may see this on the expiry day, or there are times when you may see it in the live market. The instances are very few, but there are times when the markets are not reacting much, but the option premiums are going up, and that's a question mark for many participants as to why premiums are reacting. Let's understand that option premiums go up when they are being bought. So when calls and puts both are going up with limited market movement, it clearly means that the option traders are devising long straddles or long strangles, where both calls and puts are simultaneously bought, and this buying happens when you expect markets to be volatile, when you expect markets to show a major directional move. So when the confusion is you don't know which way the markets would go, but you're sure on the volatility or a major direction setting up, you buy both calls and puts at the same time with the intent that one of them will become zero and the other one might go 3x, and the net returns on this strategy is what you look forward to. So buying of or the option premiums going up on a dull market ideally means that people look forward, the traders are positioning themselves for a major volatile market or a big directional move which they are unsure of. But one thing is sure, a directional move is coming. That is what these indications have to share.
Futures versus options, which is better?
Well, see, these are two different products which the exchanges have given us. It completely depends on a person's risk appetite. Now, derivatives means you are talking leverage. You are, keeping a limited money and going for high leverage products. So the risk aspect automatically comes in, because with higher risks, you are playing for higher rewards and vice versa. Now, the best part about options here is that there are products where, although theoretically your options in call or put buying may become zero, but options as a product offer you to participate in the market with limited capital. So when you are a buyer in a call or a put, you buy normally calls when you think the markets will be positive. You buy puts when you feel the markets would go down. So with a limited capital, because options trade come cheap. So with limited capital and a limited risk, you can play big in the market. So if you get it right, you can actually think of 2x, 3x, or even 10x if you have the appetite to wait. So options are suited well for retail investors, for people who are good at skills of timing the market, catching the momentum, or you have a definite view but you don't have that much money as you would put in futures, but with that limited capital you can take a positions in the leverage market. So options market is designed for this category of people. Comparatively, futures is majorly for people who directly do not want to get into the nitty-gritties of the options game, the option Greeks. Straight away you leverage, you have the money, you are okay to bear the MTM, you maintain a target, you maintain a stop loss. These are trading products, and with futures you can, I'm talking about majority of the traders who take a position in futures. If it is speculation, you have a target, you have a stop loss, and it completely depends upon your market timing ability and your how well versed you are with the short-term technical or any other tools which you use. But if you are good at this and you are risk averse, then futures is the right product for you.
Can you elaborate on OI analysis and PCR analysis?
See, open interest means ideally the positions which are open at one given point of time. So National Stock Exchange or any or Bombay Stock Exchange, the end of the day they come out with reports which you need to go to their websites and pull it out, which tell you as to what is the open interest at the end of the day. It means this number of positions are open. Now, when we talk about open positions, necessarily it does not mean it's only long. It can be a long position, it can be a short position. So when both positions are open, the open interest would go up, right? And you have to kind of figure out who is long, who is short, because both are present as open interest has gone up. Now, ideally, theoretically, we correlate this with the price action. So it is more of a theory that if prices are going up, open interest is going up, it means the people who have bought, they are winning, and the people who have sold are on the losing side. So technically we are of the opinion that because we correlate with the price action, we say that this is long addition. So these numbers are today available in most of the leading websites. You can even go to our apps. You can log into many websites. All this data will be free for you. So follow the thumb rule, and also do not just go by this single piece of data when you do your analytics. It will just give an open interest will just give you a direction that so many positions are being set at the given point of time. Which way it would go, you have to correlate it with the price move and some basic technical indicators to figure out the next leg of move from the current position. So that is one part. OIPCR is when it is more related to options. It means how the options data is positioned. So what we traditionally do is we divide the puts, which is in the numerator, to the calls, which is in the denominator. We get a ratio. If the ratio is above 1, it means that puts are more over the calls, and we attribute more puts to selling because put writers are smarter, they are HNI customers, and ideally they are at the winning end of the trades. So when PCR is above 1, it means more puts in the system. It means the market is slowly picking up strength, and as the PCR improves, it means the market is picking up strength. Conversely, if PCR is falling below 1, it means there are more call writers piling up and there is more selling pressure in the market. But as a contrarian, there are some extreme points, where it cannot be that put writers can be the system forever. So if call writing falls below 0.6, it means it has come to a point where you can start talking about reversals. Conversely, if put PCR ratio goes to 1.5 and above, means the puts are so heavy in the system that you should start looking at reversal. So this is how you interpret an OIPCR based on derivative analytics. How to see if option premium is cheap? See, option premium, at least for Nifty, is available by looking at IndiaVix. For individual stocks, you need to have advanced software like a Bloomberg or any other futures and options paid software. So right now we talk only about IndiaVix, which talks about Nifty. So VIX, you have to see the VIX chart. VIX chart is the base is around 8 or 9. On the upper side, VIX has gone all the way up till 80 also, but in average it trades around 15%. So if VIX is around 8 or 9%, it means the option premiums are cheap because we are trading at the lower band. So ideally, if premiums are cheap, it means that you go for option buying strategies. If premiums get expensive or around the averages, you start devising option writing strategies. This is how option premiums are looked at. How to see if percentage rollovers more than 3-month averages? For this, you need to maintain logs of rollover data month on month. If you are personally doing it, you can refer to our rollover reports which we come out month on month, and there you need not actually analyze. We do all the hard work for you. We tell you if rollover is how the average rollovers were, how the rollovers are for this particular month. So all that data crunching is taken care by us. And how to see long rollovers versus short rollover? Again, this is not a 1 month technique. You have to see how the prices along with rollover data has been faring over the last 4 or 5 months. So in case there is any you can say a red flag, like a sudden jump in rollover data. For example, let's say this month there on an average the rollovers are 78%, but and the markets were trading in the red in the last month, and suddenly the rollover data comes to 70%. So that's a red flag because it is lower than the averages. It means less of rolls have happened in the short bets, and that would be a positive indicator for the coming month, and this would work vice versa as well. So these are some of the indicators you can look forward to, but all this is covered extensively in our reports from JM Financial, which we come on the very next day after the contracts for a particular month end. So you can stay tuned and follow us there, where we would precisely and clear cut tell you about the path of the index or the stocks for the coming month.
Thank you, Akshay.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.